Canada was fortunate to avoid the worst of the crisis. And why is that? Well, it's thanks to the relative strength of our economy, our prudently managed and resilient financial system, and then there's the well-anchored inflation expectations. And Tiff Macklem, my predecessor and some of your dean, he could take a lot of credit for that. So it's not surprising that we're focusing our research firepower on monetary policy lessons from the crisis. And the first lesson is that we have to be innovative with the instruments we have in our monetary policy toolbox. Structural changes, they've reduced the economy's potential to grow without creating inflation, so potential output growth is lower. And as a result of that and other things, the neutral rate of interest is lower than it was before the crisis. And that means that if we continue to target 2% inflation, it's more likely that the policy interest rates will fall to zero than it was in the past. And remember, only a few years ago, many people believed that zero was where monetary policy was out of bullets. Well, we now observe in many European countries that they're testing this limit. And their central banks are charging commercial banks, they're charging them for their deposits, and governments are effectively getting paid to borrow. We published today on our website an interesting staff paper that looks at the experience of negative nominal interest rates in a number of countries like Denmark and Switzerland. And it finds that the cost of securely storing cash is the main constraint on how low rates can go in these countries. Now, it's too early to tell how effective negative interest rates are at creating additional demand. However, it seems in the experience of these countries, the exchange rate channel might be particularly important. Our staff, along with many other central bank researchers and academics, are also assessing how effective other innovative monetary policy measures have been. Today, we're also publishing other staff research papers that cover some of these issues. Now, the Bank of Canada was one of the innovators when we used a tool called forward guidance. And that's when central banks communicate their intentions on the path of the policy rate or other policy actions. And the evidence from our staff work shows that forward guidance, when it's clearly communicated and credible, can be an effective policy tool. And it probably works best when it's reinforced by other policy actions. Other innovative tools that central banks have experimented with to ease monetary conditions are different kinds of asset purchase programs. You've probably heard about quantitative easing. And we studied the experience of the United States, Europe, and other countries like Japan. And what these central banks are doing is designing their asset purchases based on the part of the market they want to affect. So to lower yields further out the curve, some are purchasing long-term government bonds. Or to improve credit conditions in a particular area, they bought distressed assets like corporate bonds and mortgage-backed securities. And our research found that these purchases were successful in affecting yields. Research in this area is not done. I mean, we're still studying the Great Depression, so I guess it will never be done. But this is unique in the sense that the situation's still unfolding, and it's going to take years to understand the effects of these innovations. And so research at the bank and in other central banks and academia is going to continue for a while.